What's up guys, and welcome to the Economic Outlook. Today we're doing a video about the perplexing economics and politics of China. Over the past year, the Chinese government has started cracking down on its domestic tech monopolies. In late 2020, regulators blocked the $37 billion IPO of Ant Financial, which is one of the biggest fintech companies in the country. Right after Chinese ride-hailing company Didi went public in early July, the government banned them from the App Store for supposed data privacy violations. Didi IPO'd at a valuation of $70 billion, but has subsequently tanked by more than 40%. Also, it has recently been reported that the Chinese government is considering banning the $100 billion for-profit education market. This has caused stocks such as New Oriental Education to lose close to 90% of their value in just the past few months. Given the unpredictable and extreme nature of the government's crackdowns, investors are dumping their shares of Chinese stocks. And who could blame them? If the government is willing to shut down the app of the country's largest ride-hailing company just days after their IPO, no Chinese company is safe. These recent actions are destroying the stock market, with the CQQQ Chinese Technology ETF down more than 30% from its recent highs. The tanking share prices will have an unambiguously negative impact on economic growth. But none of this is happening by accident. The Chinese Communist Party, or CCP, is enacting a carefully calculated plan to tighten their political control over the country. In this video, we'll go over why China is doing this and what the long-term economic effects are likely to be. To understand what's happening today, it's important to look back at the history. The communist government took control in 1949. While there were a few years of industrialization in the beginning, by the 1970s, the inefficiencies of the command economy were starting to show. Despite the promises of a socialist utopia, most people had living conditions similar to North Korea today. But this all changed in the 1980s, when the leader Deng Xiaoping started making liberal economic reforms. He allowed for free private enterprise and opened up the country to international trade. China's cheap labor allowed it to make industrial products at a fraction of the cost compared to Western countries. This allowed the export sector to boom. China's economy surpassed Japan to be the world's second largest economy in the early 2010s. One of the most genius pieces of China's economic policy was the establishment of the so-called Great Firewall in 2010. They banned Western internet companies such as Google and Facebook. While censorship was one motivation for this, the economic aspect was arguably even more important. The market vacuum allowed domestic Chinese companies to develop their own product offerings, such as the search engine Baidu, the social media platform QQ, and eventually the ubiquitous WeChat app, which has more than 1.2 billion active users. These companies have grown to become behemoths, indirectly creating millions of jobs and turning China into a global force in the internet and technology sectors. Of the top 10 global technology companies by market cap, only 3 of them are non-US based. 2 of these are Chinese companies, Alibaba and Tencent, which has a market cap of $645 billion. To put this into perspective, Europe's largest technology company, SAP, only has a market cap of $171 billion. Throughout the 2010s, everything seemed to be going well. The Chinese economy continued to grow rapidly, the technology companies expanded globally, and their share prices were rising accordingly. It seemed like a good situation for everyone. But everything was not perfect. The CCP has 2 main policy objectives. Firstly, they want to promote economic growth and raise living standards, just like any other country. But secondly, they also want to maintain their iron grip on political power. If the tech companies become too powerful, they can eventually fund opposition to the government and lobby for looser regulations. This will slowly erode the Communist Party's hold on power. Eventually, the powerful business interests will demand a transition to democracy. Alibaba founder Jack Ma became one of the richest men in China and turned into a culturally important figure similar to Steve Jobs in the US. He enjoyed tremendous fame and even engaged in various gimmicks, such as making a kung fu movie starring himself. But in late 2020, Ma overstepped his bounds. He made a speech where he criticized Chinese regulators as being too restrictive and criticized the country's state-run banks as inefficient. The CCP did not take kindly to such a blatant criticism. Around the same time, Jack Ma was trying to take his fintech company Ant Financial public in an IPO. Ant Financial owns Alipay, which is a massive mobile payment app in China, boasting more than 800 million users. The CCP wanted to make an example out of Ma, so they blocked the $37 billion IPO. After his speech, Ma disappeared from the public eye for 3 months, which is highly unusual for him. The Communist Party was sending a clear message to the business community. If you speak out against the government, there will be consequences. In 2021, the government has gotten even more aggressive in cracking down on the powerful tech companies. They levied massive antitrust fines against Alibaba and WeChat's parent company Tencent. They blocked Tencent's proposed merger of the top 2 live streaming companies Hurya and Douyu. And more recently, they've cracked down on the ride-hailing company Didi. These tech companies are the backbone of China's economic growth. Didi alone employs more than 15 million independent drivers. More importantly, the tech sector develops software, AI, and emerging autonomous driving technology, which could turn China into the global technological leader. As China's crackdown is suppressing these companies' share prices, they won't have as much money to invest in new innovation. Also, the regulatory uncertainty will dampen foreign direct investment, which has been the backbone of China's growth historically. So why is the government taking these self-defeating actions? Ever since China opened up in the 80s, they have struck a delicate balance between liberal economic reforms and maintaining the party's control. If the state's control over the economy becomes too tight, they'll end up with an inefficient system closed off from the outside world. But if they go too far with the liberal reforms, they will eventually be forced to turn into a democracy. Over the past decade, China has gradually moved towards democracy on the spectrum. Now they've finally decided that enough is enough, and are turning back towards more state control. So what does this mean for the economy going forward? With large private tech companies becoming less powerful, the government is investing heavily in their state-run enterprises. They recently unveiled a $33 billion subsidy program to develop their domestic semiconductor manufacturing industry. With foreign capital markets being less friendly to Chinese listings, it is now a strategic priority to become self-sufficient in strategic industries. We are likely to see state-run semiconductor companies, such as SMIC, receive significantly increased funding over the next few years. They are also spending tens of billions of dollars to fund domestic AI startups. State-owned or state-funded enterprises will make up a greater share of economic output going forward. State-owned enterprises are inherently less innovative than private companies. Private companies in high-tech industries face cutthroat competition and most of them fail. Through a process of natural selection, only the best companies survive and are able to access funding in competitive capital markets. State-owned enterprises, on the other hand, enjoy either explicit or implicit monopolies. As long as the government continues funding them, they can survive indefinitely without making any profits. This lack of urgency makes it very difficult for them to foster a culture of creativity and innovation. This is why, despite billions of dollars of investment, China's SMIC still only makes lagging-edge semiconductors. It can't compete with private companies such as Taiwan Semiconductor or Intel in more advanced fields. Similarly, the Chinese government spent billions of dollars over more than 10 years to develop their domestic aerospace company Comac. They have been plagued by design and production setbacks, and to date, there are only 53 Comac jets in operation. In the near term, it looks like the Communist Party is willing to give up some economic efficiency to gain greater control over the economy. The effect this will have on growth remains to be seen. Alright guys, that wraps it up for this video. What do you think about China's recent tech crackdown? Let us know in the comment section below. If you enjoy this content, make sure to like this video and subscribe so you don't miss future uploads. As always, thank you for watching and we'll see you on the next one.